we've always cycled from high to low. We've always cycled through boom to bust. And we're clearly more in a boom than we are in a bust now. So the bust is coming at some point. So I think you're better off keeping your powder dry and waiting for the bust, waiting for the good prices.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with a returning guest, one of my favorites, and also just my favorite part of the show, the interviews. I get tired of hearing myself talk, but I don't get tired of hearing this guy talk. And I think we both have a value bend, I guess you would say, in common that kind of brought us together. That's how I came to refer to him as my viceroy of value. I think that we have probably played therapist to each other during a lot of these moves over the last several years, but he's got a new book out. And as I'm a fan of his previous work, I wanted to have him on and talk about that new book, as well as what's going on in markets and what he's looking at. So without further ado, Mr. Tobias Carlisle, welcome back to the show, my friend. Good to have you. And I'm excited to read your new venture. And I didn't even know that it was an undertaking at present. So walk me through it. Give me the title. When did it start? The genesis story to this baby. Walk us through it.
Hey, thanks, Zach. Thanks for having me. Yeah, the new book is called Soldier of Fortune, Warren Buffett's Sun Tzu and the Ancient Art of Risk-Taking. I had this in 2020 during the COVID low. I've read Art of War a few times through my life and never really been able to understand what it was about. Never really clicked for me. And it kind of clicked through COVID. And it clicked because I'd been reading, I read Buffett a lot, read Buffett's letters a lot. And it was the first time that I had realized that they were both sort of saying the same thing. And that's that in a game with a risk of ruin, which is like Bronze Age warfare, investment, gambling, anything where your downside is zero, you have to be careful and avoid that downside. And then there are ways of shaping your bets, placing bets, and thinking. This is sort of more of a book about principles that have applied for 2,500 years. And one of them is, surprisingly, Sun Tzu sort of dealt with this, is like thinking proportionately, thinking in terms of probabilities and risk adjustments and things like that. So I took The Art of War, the way it deals with those kind of ideas, ruin, downside, invincibility, proportionality, and reward. And I put them beside some of the big deals that Buffett has done over the last sort of 20 years. So the stuff that I think was a little bit misunderstood by the market, or I don't think that he got the full recognition for. And so the three that I really talk about, well, I open with the Apple investment, which I think is the greatest trade ever, because he was well known at the time. He put such a big proportion of Berkshire's capital into it, like 40% of Berkshire's capital. And then he's had a 4 or 5 bagger on it in a very short period of time. And that 40% of capital was like $40 billion, which was a gigantic amount of money. Anybody in the world could have done it because Apple's publicly traded. Everybody's got an iPhone or an iPod or a laptop or an iPad, or has heard of Apple at least, like knows Apple. And it was in the news. Anybody could have done it. Buffett did it. And I just think that that's an example of this sort of strategy at the peak of his powers, finding something that was basically low or no risk with a potentially huge upside. And then I explain the principles of sort of Sun Tzu's as they apply to that. And then the other deals are, he did this General Re transaction in the late 1990s, which sort of saved Berkshire through the big .com bust. And I talk about the Burlington Northern, which was the big railway deal that everybody sort of thought was, it was like a capital intensive business, which was not what Buffett had invested into up to that point. But I showed, like, he got a lot of his capital back very quickly. It's paid him back now more than he invested in it, and it's probably worth $100 or $200 billion, depending on how you capitalize the flows out of it. And then most recently, the Japanese deal where he bought all of the Japanese trading houses and the significance of that. So, and the fact that like when he did that deal, he's issued debt in Japanese currency at the same time with no coupon on it, with no interest rate on it. So he's essentially getting this free carried trade where he's getting paid, dividends to the tune of 6 or 7% out of those companies. So everything that he does is this sort of genius trade. And I wanted to put it in a context of like how clever it is over using these sort of ancient principles.
No, it's one of the parts of his genius that I think gets overlooked a lot, right? Which is his returns are remarkable if you look at them over the long run. But what I've always been so impressed by was how he was able to generate those kinds of returns while risking so little comparably, meaning so many of the other great traders were good at taking big swings and dealing with kind of the outrageous, the fortunes of what is that Shakespeare line? The outrageous fortunes of
slings and arrows of outrageous fortune.
Yeah, the slings and arrows of outrageous fortune. But his ability to make what I call Grandpa Buffett bets, where everybody sees him do it and they're like, oh, that's boring, I don't want to be a part of it. And then 2 years later, they understand the structure of the deal and they understood where that juice was and how he effectively gave himself a free ride. Like the Japanese stocks was perfect, right? Take out a loan effectively at 0% interest and buy a bunch of stocks that are trading low single-digit PEs, paying out 5 to 7% interest. Dividend payments more than cover the financing costs of your loan, and you get a free ride, right? And you're doing that at a time where the yen is beat to heck against the value of the dollar, and the currency winds are at your back. You're betting on really cheap stocks, and you're not even using your own money to make the bet, right? And that's what I've always loved about him is not just. I guess maybe you'd call it the trade structure, right? Like that's what he's always been. So his deal with Occidental was similar too, right? Like when you really studied that deal, you're sitting there going, it's not zero risk, but kinda.
Yeah, I think that's really the underappreciated thing, that his returns are great, but he's done it with like virtually no risk. And in many ways, he's like taken out the downside completely or taken out the financing, or he's done something additional. Those little points of return have added up over a lifetime to the extraordinary returns that he's generated.
The other thing that I think that is such a valuable lesson to learn from him and Munger and their ilk, especially in a day and time like this, is that this is a long-term game, right? Like this is not about who gets the best returns over the next 90 days or the next 9 months or the next 18 months, right? It's a longer-term game. And I think right now is one of those times that I think that understanding that is probably more important than at any other time, because you and I have both seen crazy markets, frothy markets, markets that are overcooked, markets that are overvalued. I think this one is different for a number of reasons. But one of the things that I think is interesting about this market is this overvalue or this mania or this froth has lasted so long that I think it's simultaneously delivered what looked to me like generational buying opportunities for investors that are more choosy, right? That are willing to look beyond, the headlines, look beyond CNBC, willing to dig a little bit deeper, willing to look at international markets. What is your take? I want to talk to you more specifically about U.S. markets. And it sounds like we've got a fire alarm going off here of some kind. Hold on one second.
Yeah, can you solve it?
Pardon that interruption. That is on the production staff. So it wasn't a fire alarm, thank goodness, but somebody turned the alarm on the studio clock for some reason. So you can't get good help these days, man. So anyway, back to it. But like I said, I want to hear your thoughts about this current market. But before we get into that, I like to focus on the opportunities out there. Would you agree with me? Do you see some of those opportunities in international markets around the world, or and you and I haven't spoken about this in a while, so I'm legitimately curious to hear your thoughts. Or do you look at this as a market that you just generally feel is just overheated and that it's kind of impacting everything?
Yeah, I think that there's two I hate to say K-shaped market, but I think there are two markets when we're talking about this. You can talk about the index, but really the index is, something like the Nifty 50 in the 70s, but it's not even the Nifty 50. It's even smaller number than that. It's like the 10. If you look at the equal weight S&P 500 versus the market capitalization weight, which favors bigger companies, that's outperformed the equal weight, even though over the very long term, equal weight has outperformed. If you look at the Russell 100 versus the Russell 500, and the 100 is the biggest companies versus the 500, which has some smaller companies in it, the 100 has outperformed the 500 since 2015. But if you go back to the start of those indexes, or you use like a proxy for it using Fama and French data, you've underperformed by about 1% a year by being in the very biggest. And you can find that the S&P 500 outperforms the S&P 400, which is the mid-cap index, which has outperformed the S&P 600, which is the small-cap index. And that's ahistorical as well. Going back to the start of the data, 600 outperforms 400, it outperforms 500, and that's because they grow their earnings faster. Since 2000, since 2000, the 600, which is the small caps, has grown its earnings faster than the 400, which is the mid cap, has grown its earnings faster than the 500, which is the large cap. And that performance basically has all flipped since the pandemic. So since COVID, the mid cap and the small caps have stumbled because there has been an earnings recession for the consumer, for small businesses, for most businesses out there. Even in the S&P 500, it's really S&P 480 or 90 that are struggling. And then there's 10 stocks that are doing very well, and that's the CapEx, AI, CapEx beneficiaries. And so I think that you want to probably avoid the index, avoid the very top end of town. And I think underneath that, there is a lot of valuation. There's a lot of good value in mid cap and small cap. They're trading at about their long run averages, but they've got depressed earnings too. Since 22, small cap earnings are down. Mid cap earnings are flat. And a lot of that is rates being higher and affecting their capital structures, affecting their earnings. And some of that is tariffs more recently. Well, I don't know how much of the tariffs we've actually seen impact. I think that's mostly been headline risk and multiple contraction. But I think that there is opportunity there in the mid and small. It's just that the large is so expensive, and they've got so much capital flooding into them all the time, either because we've got this sort of continual drip from the passive, or because they've got a lot of capital to reinvest into AI. All of that has created this sort of perfect storm where these things have run up. They're very, very expensive. That doesn't mean they're going to crash anytime soon because they've got so much liquidity. But I think that in terms of the opportunity is in mid and small.
I would agree with you. The other thing that is fascinating about this market that I was looking forward to talking to you about, Rob Citron, partial owner of the Steelers, ran a hedge fund for years. Anyway, I've heard him and a couple other. We all have these moments in professional investing where you have a way or a framework in which you look at the market, or you have a way that you've come to understand things, and you're a little hesitant to tell anybody because inevitably there's always seems to be somebody out there, oh, that's nonsense. Somebody's disproven that theory or whatever. But it's this framework, and I don't know if you've had this feeling before, but I have many times where you're like, I know this kind of sounds off the beaten path here, but this way that I'm looking at the market, it's fitting, right? And it seems to be making sense to me. And one of the things that we'd been saying all for a while now is we felt like this market was doing something that was counterintuitive, meaning, and I bring up Rob Citron because I heard somebody talk to him. The assumption with AI and with passive and with all of the, high frequency trading, the assumption and the argument is that markets have become increasingly efficient. We have seen tons of evidence to the opposite of that. I think when I look at this market, I see a shockingly inefficient market as it relates to valuations. And it was heartening for me, not because I need there to be a bubble or something bad to go on, but it was heartening for me to hear a guy like Rob Citron echo that same sentiment. Just makes you feel less crazy. But when I say that, I mean things like, and I'm sure it doesn't miss you, and I think we all know what it is. It's primarily passive, and it's a stock market mania most of all. But there's so many of these inexplicable price charts. And the one that I would bring up right off the top is probably not the one that most people would focus on. But it is shocking to watch the multiple expansion in the face of the slowdown in revenue growth for Apple. As Apple's revenue growth has been cut in half, their multiple has doubled. Their margins are now down to 15%, right? I was joking. We own an airliner that has better margins than Apple, right? I kid you not. And yet the multiple has doubled. People are paying 40 times earnings for this thing. Their flagship product is losing market share every quarter, right? They've fallen more technologically behind. They've started to show all the signs of a late stage company, and meaning my 13-year-old just got his first phone. And I was shocked. I was shocked. We opened the box. Apple quit including the block chargers in there.
That's right.
And I sat there and I went, the CPAs have taken over, right? Rather than innovating, we're doing things like that to keep increasing margins. And meanwhile, their multiple just keeps going up. I'm sure you've got more egregious examples. I mean, watching Tesla's run up recently as the underlying business is disintegrating has been pretty amazing, but that one's been amazing for a long time. The Apple, in the light of the reality staring them down, is a head scratcher to me. And I think it's proof of this market becoming increasingly inefficient. What say you?
Yeah, I couldn't agree more. Apple's looking more and more ordinary all the time, and Tesla has never looked particularly attractive to me at all. They're really relying on Tesla doing something magical into the future, which they haven't done for a long time. And there's a lot more competition globally for EVs. But, there's also Meta, which is spending so much in free cash flow that they're going to be down to sort of zero free cash flow in the not too distant future. They're plowing hundreds of billions of dollars into the AI, and there's no clear revenue solution on the other side of that. And just to get over the depreciation and amortization, which, the analogy that I have heard is it's like the build out of cable in the early 2000s, except that cable went into the ground. That fiber optic cable has a 25-year useful life, and probably even longer than that. You switch out the machines on the kit on either side of the cable doesn't really deteriorate. But then that's not the story with these. Like, this is all chips that they're putting into. That's what the AI CapEx is going into. And the useful life of a chip is 4 to 6 years before it's superseded by technology. And you think about just the amount of money that's going into these things. So the depreciation and amortization schedule is hellish and kind of hard for them to get over. And then there's no revenue on the other side. Just to break even, they need to earn, tens of billions of dollars more to get over to break even on the depreciation and amortization, let alone earning. And you would want to get 15 to 20% out of these kinds of investments. So I think we're probably 2 or 3 years away before the market really wakes up, or they figure out how to kind of make a lot of money out of this stuff. But I just don't see the path there at the moment. I don't think that the math doesn't math.
No, it doesn't come close to mathing.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Here's the part. It seems like this has been big in financial journalism or financial media the last month or so. But the whole, is it a bubble, right? Is AI a bubble? And I honestly think Jeff Bezos said this weekend, and I agree with him completely, that yes, it's a bubble, but the tech is real. I thought that was the perfect answer, because anybody asking if it's a bubble, I'm looking at them going, you're not paying attention. It's a bubble by design, meaning, of course it's a bubble. These guys would tell you it's a bubble. These guys are paying multiples more than what these things are worth because it's a land grab. They have to, right? They also know this CapEx is the most VC, not only is it the biggest CapEx cycle we're ever going to see in history up until this point, but it's also the most VC-like, which is these guys are throwing tens of billions of dollars at things that they think probably won't work. And they have to, because if it ends up working and they don't have a piece of it, they're out, right? Like, so the costs are too high. But I think everybody's missing the forest for the trees. It's absolutely a bubble. They're bidding everything up to the moon, and they don't care if that hurts their stock price in the interim. They don't care if that asset goes to zero. What they've got to do And there is no dollar amount is too much to do this. They've got to make sure that they're not on the outside looking in, right? I mean, of course it's a bubble.
Yeah, that's right. They feel compelled to compete. But as you point out, there's two things going on. Clearly, the AI is really impressive technology, and it's fun to use, and it's going to have applications in robotics and autonomous driving. It's going to be ubiquitous for us all. But the internet was as much of a sea change as well, and the internet, there was a lot of promise in the late 1990s that didn't kind of pan out in the shorter term, even though here we are 25 years later and it's central to everything we do. True also for railroads. They were similarly the sort of AI capex stocks of their day because it was expensive to build a railroad and took a lot of, and it soaked up a lot of capital, and then they had a similar kind of collapse. It's just the nature of humans, I think, that we tend to get a little bit too excited about this stuff in the short term. Even though long term is going to work, we've still overestimated where we can get in a short period of time, and it doesn't mean you can't have a pretty substantial wobble in between. You know, I talk about this a little bit in the book. FOMO is nothing new. FOMO's been around forever, and Buffett's written about FOMO in relation to 2000. And the concern is always that if I don't take these prices now, the prices of the past, you know, maybe they were the aberrations, and really low prices are the unusual things, and you never see them again. But we've always cycled from high to low. We've always cycled through boom to bust. And we're clearly more in a boom than we are in a bust now. So the bust is coming at some point. So I think you're better off keeping your powder dry and waiting for the bust, waiting for the good prices.
The one that's the mind blower to me is the proliferation of so many of these just astronomically priced stocks. You know, you start looking around the indexes, and 20 to 30 times revenue isn't a big deal anymore, right? Then you look underneath the hood, and you got a company that's got some compelling tech, some compelling products, and they're growing at 15, 17% a year, still cash flow negative, and trading at 25 times revenue. The issue that I'm having with it is I understand those have been the best performing stocks. When you're buying a company for 25 times revenue, and over the last 2 years, the growth rate has gone from 35 to 18%. I don't know what you're buying. I mean, that's one of the fascinating things about this market. As long as that growth rate is staying stable or moving north, I get the exuberance and the idiocy. But now we're paying 25 times earnings on a cash burning company growing at 17% a year. I mean, or excuse me, 25 times revenue. Like you said, the math doesn't math. I'm not a CPA, but the return profile of paying 25 times revenue for a company that's negative cash flowing and growing at 15% a year, it doesn't look good.
We haven't had, you know, we had a pretty big bust in 2000. We had a pretty big bust in 2008, 2009. 2020 was sort of more like a flash crash where it rolled over and then it bounced really quickly. And the same thing happened in April this year with the tariff tantrum or whatever they call it now. We've not really had an extended bear market, which is where a lot of the weaker companies get wiped away. And so I think that's emboldened folks to invest in these things. And you can see by the number of stocks that are trading at 10 times sales and above, which 10 times used to be considered very fully valued, particularly because revenues aren't profits and profits aren't dividends. And they're not free cash flow either. There's a lot of costs you got to pay out of 10 times revenues to find out what you're actually getting. And unless it's a very high margin business, you're probably on 40, 50 times earnings if you can convert them into earnings. So that proliferation of extremely expensive stocks is, I think, because we haven't had a decent sized bust in a long time. And those are the kind of stocks that really come back a long way. And they'll be down 90% peak to trough when we actually get a bust and they can't finance externally. So the kind of stocks that I always like things that can finance internally that don't require outside capital. And they're buying back stock at the same time. So you know they're undervalued. You know management thinks they're undervalued. And that's sort of supported by my own valuation estimates for these things. All of those stocks are in the smallest part of the market. Once you get into the bigger parts of the market, they're all expensive and trading at unjustifiable valuations, I would say. So that's the part of the market that really is going to struggle. And on top of that, we've seen there are a very large number of individual names that are down very substantial amounts with there's no fanfare in there. There's no herald for these things. And it's because there's that handful of stocks that hold up the entire index. That sort of concentration in those stocks is extreme. We've never had this level of concentration before. And here we are, 5 years past one bust, with no lessons learned. Everybody remembers 2020 pretty clearly, don't they? That wasn't that long ago. 2021, 2022. We've learned no lessons.
No, you know what, man? I actually feel like that's going to become like a hallmark looking back of this period of time, which is it is the era of suspended lessons or suspended penalties or suspended debts. Meaning, like you and I have talked about. I've never seen. It's like it's also this like the era of vampire bubbles. You like never before. You'll watch something laid bare as a complete joke. It'll drop 85 to 90%, and then it'll come back. You know what I mean? With everybody knowing that it's a complete joke, right? Nobody out there thinks Dogecoin or Fartcoin are actually legitimate assets that they want to own, right? But it crashes 85, 90%, and nobody says anymore, that's why you don't buy it. They sit there and they say, it's probably a buy again. Do you know what I mean? Like that is an investor psychology change that has happened in this cycle that I think corresponds in some way with my friend Dimitri Kofinas, what he calls financial nihilism, right?
Yeah.
Like just whatever, man. I'm here to make money, but it's fascinating. Like Master, like I'm not going to make any legal over the top prognostications or declarations about the guy, but we've heard this before, right? Like his little scheme, it isn't unfamiliar to me, right? Like these are things that have been recycled. For instance, we're going to use debt that we never have to pay back to buy up this infinitely valuable asset. And we've got this fantastic new way basically to manufacture money, right? We've heard this before.
Oh, it's strategy.
Yeah.
Michael Saylor's strategy. Yeah.
Yeah. I don't know how it's going to implode, but it will, right? I mean,
well, it's heavily reliant on Bitcoin, on the Bitcoin price. And as long as Bitcoin's going up, they can issue MicroStrategy stock, buy Bitcoin, and it all gets concentrated and it looks great, but it works in reverse too.
Well, I was going to say there's these things that I've heard of before I believe they're called collateralized mortgage obligations, right? And if housing kept going up, those weren't going to be a problem.
Right. That's right. As long as the asset goes in the right direction, you're okay.
Yeah, it's the rolling loan gathers no loss, right? Just keep rolling that baby. But that's one of the interesting things that I think is going on right now is I see things, and that's kind of one of the things spiking my concern about this market is you're seeing things that are beginning to impede capital flows. Tariffs would be one of those kinds of things, right? Our theory at the beginning of the year was that tariffs were going to cause some sort of outflow of money from U.S. markets. We thought that would be buoyant for foreign currencies and foreign markets. That is played out. I don't think it's played out completely or even close. I think there's still a huge discrepancy between, or a huge delta between U.S. valuations and valuations the rest of the world over. But another thing we looked at, Tobias, and I don't know if you've looked at this, but looking at the percentage of the global market cap that the U.S. market now makes up. I believe it's pulled back some this year, but I think you're still somewhere between 65 to 70% of global market cap is represented in U.S. markets. And that is, to my knowledge, needless to say, a record. But when you look at the fact that the United States makes up about 22, 23% of global GDP, I kind of think that tells the story, right? That we make up 22, 23% of GDP, and yet our markets are worth 65 to 70%, right? If you're sitting there saying that doesn't sound logically possible, it's not, is it?
No, well, we've seen it before. Japan had the same thing in the late 90s where they were, I can't remember exactly, but similar sort of number, 15% of global GDP and half. They got up
to like almost 40% of global market cap.
40%. So similar sort of story. It's just an illustration of relative overvaluation relative to everything else. I mean, you could look at it similarly in the proportion of household assets that Americans have to the stock market. Once that gets over about 45%, you're running out of people to buy. And that's been at 47%, sort of stuck there since 2020. the level of gamble and participation in the market sort of makes it hard to find additional suckers to come in and take the bag. So I think we're at that point where we've really exhausted that. You can look at other things like the high beta index versus the low volatility, and high beta is a proxy for the speculative element in the stock market. The stocks that go up fast, people like those because they move around a lot. Low volatility people don't like because they're boring and they don't do anything. And of course, over the very long term, low volatility massively outperforms high beta. But you get these periods like now where every day it's a big win for high beta and low volatility does nothing. So it sucks all of these folks in. The level of call volume over put volume. So calls are the bullish bets, puts are the bearish bets. Call volume is massively spiking. Can't make money fast enough in the equity. You got to get levered calls. And people are making lots of money. I see them posting their accounts on Twitter, but they cut both ways. That sort of rate of growth means that you're exposing a big portion of your portfolio with leverage to the market. And if you get a reversal, then you get hurt really badly. And we'll see that happen. It's inevitable. It's the way that it always goes. So I'm a little bit nervous. That's right. I feel a lot of people are going to lose a lot of money in this market, and it's not good for society, and it's not good for investment in business because it creates this image for people, this conclusion for people that business is about speculation when really it's about financing good projects and building technology, which some of this we're doing, but there's a lot of speculation alongside it. There's a lot of speculation for stuff that's peripheral to AI. Projects are going to succeed. Most of them aren't going to succeed, and there's going to be an enormous amount of capital torn up when this reverses course.
No, and that was my point. Was it's the individual investors buying the stocks that need to worry about it, because the guys doing this, they know full well that a lot of the stuff they're buying isn't worth it. They can't afford to miss out though. And that's the thing and the other thing too, is they're looking at it through a different lens. And I was trying to tell our clients that. I go, listen, if Meta's stock drops 50 or 60%, Mark Zuckerberg is still one of the richest people in the world. Right. And now he's got a fiduciary duty to shareholders, but at the same time, not worrying about the stock valuation over the next 5 years and making sure that Meta is properly positioned for the world of AI. That is doing the right thing for shareholders. I think it's just going to cost shareholders a lot of money because they're not paying attention, right? Like, meaning if you think they're going to be able to, if you think every dollar spent is going to return the level of capital that the spend would suggest, it's not. Like I said, Bezos just told you that over the weekend, saying, of course, it's a bubble. And it is incredible to me that more people are not looking at this with a more jaundiced eye. But, in this marketplace, I probably shouldn't be surprised. Now, in closing, because I'm going to hold you longer than I told you I would, which I always seem to do. Why don't you give me a couple anecdotal stories from the book? Give me a couple of your favorites that are kind of a little preview here of what you're talking about. I know you got some good nuggets to share with us.
Well, one of the stories that I put in there is the General Re story. So a lot of people won't remember this because this was in the late 1990s, but I remember this being a pretty big deal at the time because Buffett had Berkshire Hathaway. He'd put a third of Berkshire Hathaway's capital into Coke, and then Coke had gone up 14 times. And so he had 40% he'd invested outside and done really well as well, but he had like 40% of Berkshire's assets were in Coca-Cola, and Coca-Cola was trading at 60 to 80 times earnings. So it was very, very expensive. And then on top of that, Berkshire was trading at 3 times that book value, which was also, pretty heavily watered. And so Buffett was worried that there was going to be this big reversal. And his solution to the big reversal was to merge with Gen Re. And Gen Re had a book that was mostly bonds. And he did this at a stock for stock merger, with the result that when the market collapsed in 99, 2000, the bonds rallied. And so instead of him getting punished for this big shareholding in Coke and the overvaluation in Berkshire, the whole enterprise grew when the rest of the market was falling over, and he slowly harvested those bonds and reinvested them in the market long, which is why Berkshire is where it is today. Even though Coca-Cola went on to halve from peak to trough through that entire period, he was able to sort of tiptoe through the raindrops and get to the other side. So I just use that as an example of defense is very important. You have to remember during the very frothy times that you need to defend and make sure that you don't blow yourself up. And it's hard to do with an enterprise the size of Berkshire. It's easier for us to do. We've got smaller enterprises. So I just think this is one of Sun Tzu's ideas, that you defend first, make yourself invincible, avoid ruin. Buffett does it so well in a business context. I just wanted to illustrate that idea in the book. So that's one of the stories in the book. And there are similarly other stories that illustrate how Buffett has sort of lived up to these principles of Sun Tzu's.
You know, you're talking right up my alley, because obviously risk management is what our firm's all based on. Know Your Risk podcast, right? It's risk management, and the concept of risk has always been a fascinating thing for me. It's so multifaceted, right? Like, you know, just the idea of risk. Is it ever present? Does it materialize over time? Right? It's kind of this ethereal thing that we all throw around this term, but getting down to what it really is, and then more importantly, learning how to corner it and use it to your advantage in investing is an art in and of itself. And one of the things about it, and I would assume you'd agree, the tricky thing about doing what Buffett does is that the most valuable time to do it is going to be simultaneously the time where it feels the most painful.
For sure,
right?
100%.
And if it doesn't feel painful, you're probably early, right? But if it does feel really painful, like you're missing out on the party, you're probably making the right decision.
Well, it's, you know, I think we probably sound quite bearish to people who are long and aggressively in this market, but this is the time to do the risk assessments. And when the market collapses, which it will inevitably, and when prices are cheap, that's the time to be really aggressive and bullish. When the risk reveals itself and everybody can see it, that's the time to be aggressively long. When people don't see the risk and it's not properly compensated, that's the time when you want to be more risk aware. It's been a long time since we've been careful. There aren't a lot of opportunities to really deploy into this market, but I think we'll get another one in the not too distant future.
Yeah, well, I will say that, you know, and there's a lot of these things that have run a while too. So you want to look for entrances, but you know, we keep telling investors there are opportunities. You're just not going to find them in the top half of the S&P 500.
That's right.
And you're not going to hear Jim Cramer talking about them on CNBC.
That's also right. Although when he says that he's out, that's the contrarian signal. He's out of oil and gas. So maybe oil and gas is interesting.
You notice how he never says that when WTI is at 120, right? It is remarkable to me. Now, the oil and gas call with him is a little bit more. I'm a little torn here. I think these things could get a bit cheaper, but generally speaking, again, if we think out, buying energy companies with oil trading between 60 to 50 bucks a barrel has usually had pretty good returns to it. So
it's only been cheaper relative to gold and SPY on a handful of occasions. So either gold and SPY are overvalued and have to come back a lot, or oil's going to catch up, maybe a little bit of both.
Yep. And I really do think a tide is shifting underneath the surface. And I think that fundamental investing is coming back around. And I think it's going to make a big comeback charge. I think it started. I mean, we're seeing the results and you know, the reason I say that is not sitting there blowing my own horn by any stretch of the imagination, but it's looking at the portfolio and going, that's actually going up. Look at that. You know what I mean? Where you're like, it should be going up. That's too cheap. But for years that hasn't mattered, right? So then you actually see it responding and you're like going, look at that. Isn't that something? So you're certainly seeing a bid come in there. We need to see some follow through, but there is light at the end of the tunnel. At least I hope so. All right, my friend. Well, hey, as always, I'd encourage people, give me the name of the book again. Soldier of Fortune.
Warren Buffett, Sun Tzu, and the Ancient Art of Risk Taking. It's available in Amazon. Kindle edition's out soon. Audio's out soon. Hardcover and paperback currently available.
Fantastic. And the folks can follow you on Twitter at Greenbacked.
Yeah, it's a funny spelling, Greenbackd.
Yes, there we go. And if you want to know all things fundamental and value, he's got several other books. You can find them through his Twitter website. Tobias Carlisle, thank you for joining us again, my friend. And also go to his website, acquirersmultiple.com. He also has multiple ETFs you can invest in. Zig and Deep are among two of them. Do we have any others out there yet? Have you launched any others?
That's it. Just Valley, just US Valley.
You know what, Tobias? I think your ship has come in, my friend. I think it is time for those ETFs to work, and I think you've got a good run ahead of you, my man.
I hope so, brother. I appreciate you having me on.
Hey, always my best to you and yours, and hopefully we can meet in person in the not too distant future.
Sounds good. Likewise. Thanks, Zach.
You bet. All right, you guys, we got to run, but do not keep your eye out. We got a couple other interviews coming up soon, and of course, got the Daily Dots coming out. So we'll talk to you guys soon. Have a wonderful evening. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.